You want to find high growth investments, ones that outperform the market, but you have no idea what to look for. This video is for you. So the average return from investing in stocks is about 8% every year. That's what you get for buying an index and doing nothing. And most financial advisors are fine with that. They sell average return portfolios or higher return portfolios, but with higher risk, because it's easier. And they can do that because they promote the myth that high returns has to equal higher risk. And everyone believes them because it's difficult to find somebody to trust. But I'm not interested in these low value portfolios. And since you're here watching this, neither are you. I've spent the past decade dissecting what actually drives outsized returns, but most importantly, how to systematically find them without relying on luck or timing the market. And what I found is this: there are a few key frameworks that help capture high growth opportunities. These will help you avoid the noise and allocate capital intelligently. And when used right, these frameworks don't help you just beat 8% a year. They help you compound wealth far above what the average investor ever experiences without additional risk. So before we dive in, let me introduce myself. My name is Daniel O'Loughlin, and I've spent years as an investment analyst at S&P Global. I hold a master's in finance. I'm a chartered alternative investment analyst, and I've published highly impactful research that's changed beliefs on how assets are valued. But more importantly, I spent over a decade building my own frameworks that consistently outperformed the market and allowed me to quit my job to manage my own personal wealth full-time 4 years ago. So in this video, I'm going to walk you through the exact principles the best investors use to find asymmetric investment opportunities, ones with high upside, limited downside, and massive long-term potential. So let's dive in. So let's talk about a concept that separates average investments from the once-in-a-lifetime ones: network effects. Many investors ignored Facebook in the early days. People said that the valuation was insane. Many couldn't wrap their head around how a site with no profit kept being valued further and further into the billions. But the mistake wasn't the price, it was the framework. If you understood Metcalfe's law at the time, you'd have paid anything to get a piece of it. Now bear with me in understanding Metcalfe's law, because if you understand it, you can benefit greatly. Now I'm going to give you the definition, but I'll explain it more simply after. So essentially, Metcalfe's law states that the value of a network is proportional to the squared number of connected users in the network. In simpler terms, the more people that are connected to a network, the more valuable the network becomes. But that value doesn't grow linearly, it grows exponentially. So if a network has n users, its value scales as roughly n squared. So when Facebook, which is a network, doubled its users, its utility didn't just double, its utility 4x'd. Every new person made the platform more useful for every existing user. That's a positive feedback loop that many investors never factored in. So it's not about linear growth. It's about adoption curves and virality. Facebook wasn't a social media company. It was a network utility. It was more like a modern telecom, but global, digital, and scalable. So here's the hard truth. Traditional valuation models, like the discounted cash flow model, or DCF, break when you apply them to networks. Why? Because they can't price exponential compounding. They don't know how to model reflexive demand. And that's the exact force that makes asymmetric upside possible. So whenever you see rapid user growth, increasing engagement per user, and a system where new users increase the value for all the users, you're looking at a potential outlier investment. So when the herd says that, oh, this company is overvalued, but you can see network effects at play, you could stand to win big. Now the next topic I'm going to talk about is a fundamental concept. People think they understand it, but they really don't at its heart. And I'm talking about the supply-demand equation. Most investors wait until the price is already up 100% before they ask why. But if you understand how supply and demand really moves markets, you can catch these moves before they happen. Let's start with real estate. It's 2020, mortgage rates hit 2.6%, so it's very cheap to get a mortgage. Work from home becomes permanent, everyone wants more space, and millennials start buying homes in droves. Demand surged and supply couldn't move. You can't 10x home construction overnight, and inventory was already at record lows. So the result? Prices are going to go vertical. And in some cities, it went up above 30% in a year. It wasn't a bubble. It was a simple case of increased demand and a fixed supply. Now let's take a look at Nvidia. Everyone thinks it's an AI stock. That's the headline, but the story goes deeper. Nvidia sells GPUs, and back in 2015, that meant gaming. Then came crypto, and suddenly everyone's mining Bitcoin and Ethereum. Then came deep learning and AI research. Then ChatGPT dropped and other LLMs. You need to look at demand differently here. Demand wasn't just increasing, it was compounding. So yes, AI is growing, but it was also built on gaming growing and cryptocurrency growing. And so when a company starts expanding to other customer segments while still growing its original customer base, that's when you see compounding in action. Now here's the catch. GPU supply is not elastic. You need cutting-edge fabs, years of research and development, and months to manufacture a single chip. So what happens when demand starts to spike and supply is fixed? Price has to catch up. That's why Nvidia didn't just rally, it exploded. From $1 in 2016 to hitting above $100 in 2024. And you didn't need a crystal ball, you just needed to know what to look for. So whenever you see a fixed or inelastic supply, exponential or belief-driven or policy-driven demand, lack of inventory or production lags or just a long lead time, you're possibly on the verge of finding something that's going to make an asymmetric price move. Another method of finding high growth opportunities is through finding access to specific communities that gather around a certain asset that also show high conviction. So remember GameStop, how it went from $1 up to $80 in less than a year. Well, that was because of a community that gathered on a Reddit forum, Wall Street Bets, and they had a high conviction idea. Here's what most people don't get. When you combine conviction with community, you can move markets. So here's how you can do it. In 2019, I co-authored a paper published by the Capco Institute. In this paper, I scraped thousands of cryptocurrency forum comments and inputted it into an AI program that I developed. The program could read every single comment and assign a score to each comment of whether it was positive or negative. If people were saying on a given day, oh, this is a good investment, it would get a positive score, for example. And it would compute at the end of the day whether overall most of the comments were negative or positive on that given day. This research resulted in a statistically significant algorithm where during the days where people were heavily commenting positive and bullish statements about any given cryptocurrency, the following days would result in a price increase for that specific cryptocurrency. And it makes sense because people would log on to the cryptocurrency forum, they would read all these bullish statements about a potential investment that they would like to make, and they would make their decisions based on this. So imagine having a tool that tells you what to invest in the day before it starts to increase, from something as accessible as an internet forum. This proves that psychological biases such as herding behavior and anchoring bias are real and can be profited from. I didn't rely on gut instinct, I followed data, and data helps you profit. And that's what we do at Seneca Private. We help you find high growth opportunities just like that. So if you're getting some value from this video, consider subscribing to never miss content like this. And if you're an entrepreneur or high net worth individual who wants access to their own private wealth desk, where we identify and capture these opportunities for you, then click the link in the description for more information. Or you can visit senecaprivate.com/apply. Now back to the video. Regarding these insider communities, there's a catch that you need to know how to apply this correctly. It only works when the asset is small in terms of market cap. GameStop, for example, had a sub 2 billion market cap before it had its price explosion. That's why Reddit could create that squeeze. But let's take another asset where there's communities that show just as much conviction, if not more, than Wall Street Bets. The asset I'm talking about is silver. These guys on Reddit have been pushing this narrative that a silver short squeeze is on the way, and it's picked up tremendous momentum and buying from this community. Now they've been stacking for years and their community keeps growing too. So why hasn't the price exploded yet? It's simply because silver has a market cap of over $1 trillion. Therefore it's going to take much larger macroeconomic pressure rather than just retail investors to move the needle. It's just something to be aware of before you pull the trigger on an investment like this. So here's the framework. Prices can scale based on a function of conviction and community, but that impact scales inversely with market cap. So when you see niche communities form around small cap assets, don't dismiss them, especially when there's high engagement, viral memes, and coordinated buying. That's not noise or silliness. Well, it could still be silly, but it's still alpha hiding in plain sight. So here's the next concept, talent flow. Want to know where the next wave of growth is coming from? Follow the talent. High growth opportunities don't just suddenly appear. They form where the most talented builders are going. And over the past 2 decades, that flow has been incredibly predictive. So from 2005 to 2010, engineers piled into software and enterprise IT. That's when the web scaled. And that was an opportunity to buy stocks like Salesforce and Google at incredible prices. Then between 2010 and 2015, the best minds were moving towards e-commerce and mobile. That's when Facebook and Apple made clear sense. Then from 2015 to 2020, it was all about machine learning, cybersecurity, and clean energy. And now in 2025, we're seeing it all again. AI and automation aren't just fields, they're eating every sector. If you can spot where the builders are going before the masses do, you're early to the curve. And being early to spot talent migration is one of the most asymmetric edges you can get. So when you notice top engineers leaving top tech companies for other industries, PhDs publishing increasing research towards a certain topic, or the smartest people you know quietly switching industries, you're getting a front row view of where the next wave could be coming from. Don't just wait for earnings, follow the talent. Now, some of the biggest trends in investing don't start with economics or financial analysis. They start with stories, massive, emotionally resonant, globally shared narratives. And if you can spot these narratives early, before the world rewires around them, you get asymmetric upside. Let me show you. Take clean energy and decarbonisation. The 2020s hit different. Energy security collapsed, climate anxiety was spiking, and suddenly everyone, from activists to governments, agreed on one thing. The world needs cleaner energy and fast. So here's the signal that was given. Governments lined up over $2 trillion in green infrastructure stimulus. Every automaker retooled their electric vehicle roadmap. Grid operators started rethinking their old systems. And startups, they exploded. Everything from battery tech to nuclear fusion moonshots. The narrative had momentum, but the infrastructure didn't exist yet. So if you understood this alignment back when it was growing legs, in 2019 or even 2020, you could have bought Tesla or invested in lithium or backed battery storage startups before they all exploded in price. In our 2020 annual investment letter, a letter that I publish annually for friends and family and now clients of Seneca Private, I noted my observation of this narrative and recommended a play on solar energy companies, specifically three: Encavis, Enphase Energy, and SolarEdge Technologies. And the result in 1 year after releasing that letter was that Encavis returned a 60% return on investment, SolarEdge returned 250%, and Enphase Energy had a huge return of 530% over the year. So here's the insight. Narratives drive policy, policy drives capital, and capital drives exponential growth. You don't even need to predict the exact company. You can even buy an index fund relating to that industry that you see this potential from. You just need to be able to see the direction of inevitability and position yourself where belief is going to compound. So here's the model. Many breakout financial trends start with a worldview shift. It's about being early when the narrative turns from being possible to inevitable. So you don't need a massively diversified portfolio consisting of hundreds of assets. You need an efficiently diversified portfolio consisting of bets that have the odds tilted in your favor. That's the game. The biggest winners in investing spot these asymmetric opportunities, allocate intelligently, and then let compounding do the rest. If this video has helped you think differently, consider subscribing. And if you're a high net worth individual or founder sitting on capital and want exclusive access to your own private wealth desk and someone who knows how to find these opportunities for you, click the link in the description for more information. Or you can go to senecaprivate.com/apply. I look forward to seeing you in the next video.